Welcome back, everybody. If you're new here, one of my number one goals of this channel is to deliver as much value as possible in the shortest amount of time possible. So let's get into it. Today we're talking about the disappearance of the middle class and all of the wealth transfers that have happened over time. It's no secret, times have definitely changed. Your parents and grandparents, they were able to afford a house on one income, they had pensions, assets were cheaper, college was affordable, and oftentimes could support a family with one job. Today, two incomes barely cover rent. College is super unaffordable. Retirement ages are getting pushed back further and further, and you're working harder than previous generations by a long shot. And if you feel like you're falling behind despite doing everything right, you're justified to feel that way. The game has definitely changed, and today I'm going to show you exactly what happened to the middle class and where all that money actually went, and some of the things that you can do today to make a difference in your life. So to make something clear, the middle class didn't just disappear. The US population has been going up and up over time. And for this video, I'm talking about the last 50 to 60 years where the population has definitely gone up and the middle class has dwindled during that same period of time. And during the last 50 or 60 years, people have seen their wealth taken from them in many different ways. Just to name a few, jobs were sent overseas, companies replaced pensions with 401ks, and the never-ending cycle of financial calamities where massive wealth transfers take place every single time, and all it does is concentrate more and more wealth at the top. And here's a few visuals just to explain everything. This is what's called a D-shaped economy, B-shaped, and a K-shaped economy. Here, where it's D-shaped, it's pretty even. Here, where it's B-shaped, there's a little dent in the middle, and then K-shaped, there's an area at the top, nothing in the middle, and an area at the bottom. The green represents the ultra-wealthy elite, the blue is the middle class, and red means those who are impoverished or really, really low incomes. And as we can see, the D-shaped economy is actually pretty well balanced. You have some people who are really rich at the top, that's okay, and you have some people who are pretty poor at the bottom. But here in the middle, you have a very robust, plenty of room for middle class, for people to pull themselves out of poverty, a lot of opportunities to get here in this middle part of the economy. But as time went by, things started to become a little more unbalanced. The big chunk of the middle class has been taken out as recessions take place, crashes, you name it. And there's fewer and fewer opportunities here in the middle class. You can see this blue area starts to get smaller and smaller. This green area at the top gets a little bit bigger, and this red area down below starts to get bigger as well. And what we have today is a K-shaped economy where there's virtually no middle class. And you can see here the red representing those who are impoverished, very low incomes, and those in the green, the elite, the super rich. Those pools of people are getting bigger and bigger. The people in the middle class back here, and even back here a bit, they got squeezed in one direction or another. And unfortunately, as people lost their homes during 2008 financial crisis and lost a lot of money in the stock market in 2020, maybe they sold their stuff, that wealth was transferred to somewhere else, to someone else. And that's why here nowadays we have what's called a K-shaped recovery or a K-shaped economy where things are very unbalanced and there's virtually no middle class. But let's go back in history. From the 1940s through the mid-1970s, worker productivity and wages, they moved together. There was a strong correlation between a worker's productivity and their wages. When workers produce more, they earn more. It's a very simple deal. You work harder, you're going to get paid more. The American dream was actually intact back then, not just a figment of our imagination like it is today. But then in the 70s, something broke. Productivity increased by over 60% since the early 1970s. Workers were producing more value than ever. But when it comes to wages, they've barely moved. Adjusted for inflation, the average worker's pay has increased less than 30% over that same period of time. And I'm talking about real purchasing power. Many workers today, compared to their predecessors in previous generations, they're actually making less compared to those in the 1970s. So let's think about that for a second. You're working harder, you're producing more, technology is better, and somehow we're all poorer than previous generations. Not to mention, most of us are saddled with multiple forms of debt, like an auto loan, student debt, credit cards, you name it. So a big question is, where did all that money go? Because the value was created, the productivity soared, Someone got that money, and it wasn't any of us. And since the early 1970s, has been the biggest wealth transfer ever recorded in history. And it happened gradually, slowly over time, so people didn't notice until it was too late. So the first point is asset inflation. This is one of the places where money went to. In 1971, Nixon took the dollar off the gold standard. This meant that instead of having a balanced budget like you or I have to, the government just started printing trillions of bonds out of thin air to bridge the gap of budget deficits. And the termination of the gold standard was where the disconnect between productivity and wage growth started. And this is also when asset prices started going up astronomically. When your parents or grandparents are looking for a house, it cost about 2 to 3 times the average household income. Whereas today, it's about 5 to 8 times, or in some extreme circumstances, depending on where you live, it can be over 10 or even 15 times the average income. But here's something to keep in mind. Houses didn't get better. The structure, the materials, the square footage, none of those went up 10x. The houses didn't 10x in size like the prices did. So why did prices explode? And here's how this works. When governments print money out of thin air and keep interest rates artificially low for a long period of time, that money doesn't flow evenly in the economy. It flows to assets first. Stocks, real estate, precious metals, anything you can buy and hold, all the prices of those assets went up. And if you bought a home in 1980, congratulations, you're probably a millionaire right now. Same goes if you owned stocks, precious metals, any sort of tangible asset. Your wealth multiplied over that period of time, not because you worked harder, I'm not saying you didn't work hard, but this is the reason why, is because you owned things while money was being printed, and all those printed dollars chased assets. Whereas today, if you're just entering the workforce, trying to save some money, trying to maybe buy a house, you don't want to pay rent anymore, the money printing has made everything so expensive for us. It feels like you're treading water. And the prices of everything are going up faster and faster, and wages are not keeping up. So how can you possibly save for a house when you get a 2% raise at your job? But the cost of food, vehicle, rent, it's going up much faster than 2% year over year. And this is something that the baby boomers don't seem to understand when it comes to younger generations. They bought a house for $50,000, let's say, on a $20,000 salary, whereas today, your average home is about $500,000 and the average salary is closer to $60,000. And they'll tell you, I worked hard for this house, and I'm sure they did, but they just don't understand the economic headwinds the younger generations are facing and the economic tailwinds that they had to boost their wealth and their asset prices, especially interest rates going from their highest in the 1980s all the way down to zero in 2020. When interest rates go down, it makes money really cheap to borrow. And when money's cheap to borrow and the government is printing trillions of dollars, all those dollars are looking for a home and they're chasing assets. And that's what makes asset prices rise. And to summarize this portion of the wealth transfer, it's inflation, but not the type you see at the grocery store. It's asset inflation, the kind that makes people who already own assets richer while making it impossible for everyone to catch up. And here's the second place a lot of this money went: corporate profits. But before we jump in, please do me one favor and hit that like button. Every like and subscriber I get helps me turn this channel into a real side hustle that can help me break free of the 9-to-5 grind. Thank you. Now, back to corporate profits wiping out the middle class. In 1965, the average CEO made about 20 times the average salary a worker made. It's high, but not unreasonable. But today, CEO pay is over 350 times the average worker. Don't get me wrong, being CEO is definitely a difficult job, but it doesn't seem right that CEOs are making 350 times more than the people who are putting in the work every single day. And corporate profits as a share of GDP have skyrocketed. Productivity has continued to go up, profits have gone up, but wages have stayed pretty much flat. In a little bit of history leading up to today, unions, the decline of unionization since the 1950s has had an effect on the middle class. In the 1950s, about 35% of workers were unionized, and today it's only around 10%. And like them or not, unions force companies to share that productivity and all those gains with their workers. And without that pressure from a union, companies are just keeping the gains for themselves, as we're seeing today. And there's an Ethiopian proverb that says, when spiders unite, they have the strength to tie down a lion. And what that means is that unions could bring CEOs and stakeholders and all those executives to the table and ensure that there was profit sharing, good benefits, PTO, safe work conditions, not things that are unreasonable. But moving on, shareholder supremacy. The corporate philosophy shifted to maximizing shareholder value. Workers then became a cost, not partners to invest in, which is why you see companies rapidly trying to replace their workers with AI or consolidate positions. They don't care about their workers, they care about shareholders. And the next thing is stock-based compensation. CEOs started getting paid in stock options, so their incentive became drive the stock price up at all costs. That even means suppressing wages, cutting benefits, and buying back stock instead of giving money to their workers. Every time you see a huge company lay off thousands of people, the stock price goes up. Why? Because that means that costs are getting cut, and that's good for the stock price. So the result of all of this, the productivity gains went to shareholders and executives, not you. You made your company more profitable, but instead of sharing it with you through raises, they did stock buybacks and gave their CEO a bonus. Moving on, number 3, inflation, the hidden tax that we all pay. The government tells you that inflation is 2 to 3% year over year. But have you noticed that rent, car insurance, groceries, they seem to be going up daily, much further and much quicker than 2 to 3% year over year. And that's because the official numbers that they come out with and use are manipulated to look like things are okay. And trust me, both political parties do it. But the real inflation that you pay is much higher than the official numbers. But your pay raise every year is based off of those official numbers. So you get a 2%, maybe a 3% raise, and inflation is 5%, and that happens over a couple of years. You're falling way behind year after year. And who benefits from this inflation? Debtors, especially the biggest debtor in the world, the US government. They borrow money and then they pay it back with devalued dollars. So then all of this has led to the K-shaped recovery that we've seen today. And this all came into focus during and after the pandemic when trillions and trillions of dollars were printed, and not very much of that money made it to the poor and middle class, and most of it got accumulated at the top. So picture one line going up, the people who own stocks, the people who own homes, investment portfolios, the market soared, home values have skyrocketed, the wealthy got much wealthier. Then you have the other line that goes down, the people who worked service jobs, hourly jobs, small businesses, owners who went bankrupt, renters who were told to leave if they couldn't afford the ever-rising rent prices. They were the ones who were devastated. So now we have two groups, or a Bi-Modal wealth distribution system in America. We have the ownership class and the working class. And there hasn't been a gap like this since the Gilded Age. And this is the middle class disappearing in real time. You're either moving up into the ownership class, buying assets, owning a home, building wealth, or you're sliding down into a permanent worker class where you have this feeling where you'll never be able to catch up. So if you're feeling angry, frustrated, or left behind, you're justified to feel that way. This isn't about you not working hard enough. It's not about too much Starbucks or that younger generations are lazy. None of that is true. The system has changed, the rules have changed, and the results have as well. And people might give you advice based off of a playbook that worked for them, but it doesn't work anymore. The world that they knew with the big middle class, that's gone. But this is the hand that we've been dealt, so what can you do about it? And remember, nothing here or anything on the internet should be taken as financial advice. But I want to hear what you have to say in the comments below. Strategy number 1, become an owner, not just a worker. Remember, asset inflation is where most of this wealth went. The only way to benefit from that is to own assets. Buy a house if you can. Yes, easier said than done. Do what you have to do. Have roommates. House hack. There's 100 different ways that you can make this happen. Now, it's not going to be easy. You might have to move in with your folks for a little bit, save some money, pay down some debt first. But if you want it, you can get it. Because if you think prices are high now, I guarantee you they'll be higher in 10 years. And maybe you can't afford a house right now, but that doesn't mean you can't invest in the stock market. Even $100 a month in a low-cost index fund will compound massively over time. The S&P 500 has returned about 10% annually over the long term. You want to be on the side that benefits from asset inflation. And also consider starting a business. More than just collecting a salary, you'll have all kinds of tax advantages that the wealthy have been using for decades. The point of this is you don't just purely want to be a worker. You want to start owning things, even if it's very small to start. Strategy number 2, start aggressively eliminating debt. Many experts out there suggest paying down your highest interest debt first. Credit cards are essentially stealing your future at a 20% interest rate. Take that personally. Strategy number 3, one that I've been doing, is prepay your mortgage if you have one. This might be controversial. Some financial advisors out there say invest instead. You'll get better returns. And mathematically, at times, depending on how cheap the stocks are or how high or low the interest rate is, they're right. But here's what they miss. Yes, the math can be right at times, not always, but there's a peace of mind. There's a huge value in having peace of mind. Owning your home outright means you can survive on much less income. You're not vulnerable to job loss or economic downturns. You've removed a major expense from your life permanently, and it's proven that paying off your mortgage lowers blood pressure. Strategy number 4, developing high-value skills. Some jobs are keeping pace with inflation better than others, those in tech, healthcare, specialized trades, electricians, plumbers, right? Those fields have better bargaining power. So invest in yourself. Learn skills that are in demand. Don't assume that your job is going to exist in 10 years. You see what's happening in AI. Be ready to pivot. Who says you can't start something new today? Strategy number 5, optimizing your taxes. The wealthy stay wealthy because they understand the tax code, and you should too. Look into maximizing your retirement accounts like a 401k, an IRA, a Roth. Those are tax advantage retirement accounts. Make sure you understand deductions if you're self-employed or have a side business. A popular one nowadays is an HSA. It's triple tax advantage. You're already losing ground to inflation and wage stagnation. Why lose any more to taxes if you don't have to? And the last one, strategy number 6, increase your income aggressively. In a normal economy, maybe back here when it was a D-shaped economy, loyalty to your employer seemed to pay off, but not anymore. Studies show that people who switch jobs every few years earn significantly more than people who have stayed put. Your current employer might give you 2 or 3% year over year, but if you switch jobs, maybe you could get an 8, 10, maybe even a 15% raise. So make sure to negotiate hard. Switch jobs if you have to, if it's possible. Start a side hustle. Ask for raises. In an economy working against you, you're going to need every advantage. So as we can see, the middle class is disappearing, and the wealth transfers have already happened and are going to continue to happen as time goes on. But it's very important you understand what's happening so you don't fall behind forever. I don't know what it would take to go from a K-shaped economy back to a well-balanced D-shaped economy. And if it does happen, it's not going to be happening anytime soon. But with that being said, you don't have to accept this as your outcome. Buy assets, kill debt, build skills, increase your income, protect yourself from inflation. I get it, the system isn't fair, but you're not powerless. So that wraps up this video. But before we go, I'd like to hear what you're doing to build wealth in this economy. Are you paying off debt? Are you looking to buy a home? Drop a comment below. I'd love to hear from you. And if you enjoyed this video and found value in it, please hit that like button to help support me, and make sure to subscribe for more videos just like this. Thank you very much for watching. I'll see you next time.